Welcome everyone back to another Kingscrowd Podcast. This is where we break down the latest trends, investment insights, and other happenings that are going on in the online private markets. As always, I am joined by two of our colleagues here at Kingscrowd, Leah and Scott. We are going to be talking about a couple different topics today. The first thing we will be chatting about is the Reg CF Trends in March. So we took a look at the total capital that was invested, and we will go into whether that is trending up, trending down, and what it means in the context of just the broader public markets and all the volatility that we're seeing in the public markets today. Then in our second segment with Leah, we're going to be going into a deal review this week, which will be taking a look at Rise Robotics, currently raising on WeFunder. Let's jump into our first segment. I'm going to pull in Scott Katoon here. Scott, welcome back to the show, as always. We took a look at the funding report for last month in March because for the online private markets, we saw somewhat of a quieter time in February, but March was actually a pretty good uptick. I can pull up the chart here as we share it. There was roughly $44 million raised, which was a pretty significant increase. I think it's a 58% increase month over month versus February, and also a year over year increase. Now,
I was surprised, by the way, with the Legion M. I saw that at the bottom of the chart and was like, whoa, I didn't even know they were still raising. It's amazing.
Absolutely. Actually, that's a really good point. So for those who aren't aware, we put out these monthly funding reports, and there's some awesome new visuals that we've been experimenting with so that you can also drill down by platform and take a look. So here shows all of the capital that was raised in the month of March 2025. You can see, WeFunder, Dealmaker, Net Capital, Equifund. And within each of those, you can drill down. And for example, Equifund had Eagle Energy Metals Corp, which maxed out their raise. So they raised $5 million. You could take a look at Net Capital, for example, and if we click on that, you can see that Avadain was a big raiser on Net Capital and also MagFast. So all of these let you drill down further into the Kingscrowd data. I think it's really interesting. But to your point, Legion M, Rise Robotics, this is another serial issuer that's on there a lot. So raising on Dealmaker, looks like they raised $5 million as well last month. And then obviously WeFunder, Start Engine, continuing to be strong performers. For the month of March, Pirouette Medical did raise out their maximum of $5 million as well. Now, one of the things I thought was interesting, where I want to get Scott's opinion, is we saw this uptick in March. However, I think as anyone who isn't living under a rock has been aware, there's been a ton of volatility just between the news in the public markets, the tariffs, and everything else that's going on there. Scott, what do you think is the takeaway, and what are some of your opinions in terms of where the online private markets may be going in the context of everything else going on in the public markets today?
Yeah, it's a great question. I think, one, I don't think there's a correlation between the March and April performance or what we're going to see in this. I think you had a bunch of deals that are very familiar, like Rise Robotics. I feel like they've been raising ever since the first day you could raise. I don't know what's going to happen there. I would love to see something out of that. It's also funny. First off, I love this chart. I think it's interesting when you look at the chart, the type of companies that raise via crowdfunding successfully. And it just seems to be so clearly like not just startups, but almost like alt startups, like medical, robotics, science, big concept stuff. But just as like a super interesting observation. So with that said, I think the public market stuff, I said this on my podcast yesterday or whenever I pushed it out. Invest with your eyes and not your ears. There's so much noise. It's almost like the individual people, whether it's the talking heads or the hedge fund managers or whatever, they all want to push people to do one thing or another. I have not checked the markets as of the recording of this show, but I was up like 5% today when I started the day off, coming off of about a 14 or 15 point drop yesterday. I know that we lost, another 7% or 10% on Thursday, Friday last week. It sucks. No one likes a sell-off, but it's like not Armageddon, and everyone's making it out to be like Armageddon. And it's like, will the tariffs, maybe cause that? It might. I don't know. I'm not an economist. I think any idiot can point out like the areas that are very obvious pressure that it puts on the U.S. Economy. But I think that it's just another example. I was talking to a PE firm. Actually, it was a wealth management buddy of mine. who said like all of his investors were basically asking him like, why are we not more exposed to uncorrelated growth opportunities? And it was like, well, I put them in front of you for the last like 3 years, and you just were like, it's, stonks go up, and you had no interest. And now when you have like a sell-off day or a panic sell day, now everyone wants diversification. And I just think it's like, this is a lesson that should only have to be learned once. And yet here we are again. We just experienced this in 2020 with COVID, and obviously about 5 times for the people on this call's age since that. Why can't we realize that you've got to, even, retail or not, you've got to have allocation into real assets, private real assets that it could be a startup in some cases, although it's obviously very high risk, but like any alternative asset that does not have daily volatility. Because then when a sell-off like today happens, or yesterday or whatever, like next thing you know, your entire portfolio feels like it's bent in half, and you have no recourse. You have nothing to be like, hey, a 50% rollout for some people is only 30% for me because I'm allocated 15 to 20% of my net worth into private, more, good growth, but like more stable investments. I hope that this is another, opportunity for the everyday investors. I don't care about the rich people, the everyday investors that we deal with and talk to at Kingscrowd and other. It should be an eye opener, another opportunity to be like, hey, maybe I should spend some more time learning about alternative investments and private stuff. And I think it's also going to be an opportunity for all of the big firms out there to be like, hey, maybe we could roll out some of our private opportunities to the retail market. And I hope we see more of that. I do think that it has ultimately, assuming the market doesn't absolutely collapse, it has a very net positive response on what will happen next for us and, kind of the asset class we talk about.
Yeah. And you bring up one point, that there's diversification into, call it the private markets, right? And then within that, you still have, private credit. It could be startups, venture, it could be collectibles. There's a whole bunch of different assets that may have different levels of correlation with or with not. But one of the things I find interesting when I reflect on kind of my own portfolio, some of the startups that I invest in, they're not necessarily fundamentally different than the stocks that are trading on these microcap exchanges, right? Or on the NASDAQ. But even for myself, I think it is this psychological barrier, right? Where as long as your stock isn't trading and you check it every hour of every day to say, oh, it's up 5%, oh, it's down 10%, that wreaks havoc on just the human mind and the psychology. And by having in the private markets doesn't mean that your companies aren't going to be going through the same ups and downs. But, by not seeing it every day, I actually think that helps me personally be more invested for the long term, right? Like I'm not thinking as much about like the short-term returns of my portfolio. It allows me to focus more on the longer term by having these things that are liquid. So I know liquidity is often one of the things that's cited as risks for investing in startups, but I actually see that as a bonus sometimes for my own portfolio. I don't know how you feel about that.
I agree with you. I mean, I think the great solve that unlocks a lot of what we've worked on for the last, 8 years plus, Brian, is like the liquidity. Solve liquidity, and the retail investor can now play in. And I agree with that. But I also think that like, just because you can sell immediately, you start to act like panic seller, panic buyer. I think the quarterly redemptions and like, yeah, I know we're going to tokenization, and whether that market creates itself or not is like a very different podcast question. I do want us to get there, and I want the availability for it. But I totally agree with you that we are way too reactive. I think retail investors, and I don't mean this as a slight, it takes like a lot of scars. Like I deal with wealthy people who have invested in a number of startups, and then as soon as one goes south, they like freak out. My phone's blowing up, and it's like, haven't you been through this? Like, I don't understand how you're like still doing this. Retail investors are the same way. We go on a Robinhood app, we put $10,000, then we watch it. And I think one of the biggest problems, this is like such a life problem. It's not Robinhood. It's an us problem. The notification app generation, whether that's Instagram, it's Twitter, it's LinkedIn. God, I hope it's not LinkedIn, but like any other place that you get constant notifications, it wires your brain to act either hysterically, manically, or irrationally. And the stock market, when things happen like this, whether it's everything going up, like when Bitcoin was going through its major boom, you're getting notifications like every app, every altcoin's going up. Invest. You pour all your money in it, and it's the exact opposite. It just pulls you into a depression when you watch notification. Like my entire phone, and literally right now during this conversation, just blew up with Robinhood. Like,
I was going to say, you're not up 5%
sick.
anymore. Don't check the market.
Yeah. It just said down 5.2 across everything. So I won't check, but I put it on the home screen because I don't care. I'm not going to sell it. I would recommend to anyone who's doing this, like, if I could give you 2 bits of advice, and never anything I'm saying is investment advice. So, like, don't do anything I say, just laugh and move on with your day. But truly, stop notifications, pause them on your phone. You should pause it for everything, really, except for like maybe text messages. But pause your notifications on financial apps. I think it makes a hysteria, and it's weird, and it just screws things up. Set markers. There's a certain price of certain things I'm invested in where, like, I really need to know if it goes below such, because then I got to get out of it. But otherwise, like, ignore. And then the other thing is, truly, I'm not telling you to invest in like the HL PIF that I keep talking about. Like, pick whatever you want. Do some research on private real asset. And that can include startups, but I mean really, like, infrastructure type things, real estate type stuff that doesn't go to zero, doesn't fluctuate this crazy. And quite honestly, usually during times of sell-off like this, it actually increases in value because people are looking for safe harbor. And I think that's the thing that for right now, like, retail is missing. They've got all the access and more that they could ever ask for on crypto stuff. And, by and large, it has proven to be correlated. Whatever Bitcoin Pomp wants to say about uncorrelated, he's full of shit. It's correlated, or at least it certainly seems to be. I think we're ready for the next wave of investments. And I personally, if I could pick it, it's something safer. I think the everyday investors need to start putting their money in stuff that grows, benefits from compound interest, but ultimately doesn't tank. Like, every 6 months, there's not like a 20% drawback. Like, it makes you nuts.
I know there's some big name investors out there who will tell you any asset class you invest in, there will probably be a drawdown of at least 30% a couple times every decade, maybe 50%, right? Like, once in your life. So regardless of what you're investing in, you just need to have the fortitude to, like you said, I love like having a plan, even whether it's with my public market stuff or my private markets. Like, why are you investing? Like, write it down, have a plan, set some of these triggers in advance, because that helps protect you from yourself when the emotional part starts coming over you.
I totally agree with you, Brian. You have to zoom out. Like, I've told people this before, stonks always go up if you zoom out far enough. They always go up. Like, there's drawbacks and things go down, but at the end of the day, like, we continue to go up. Even if it goes like that, it still goes back up when we start again. Like, it's a good investment to be exposed. It's just sometimes you're in a bad, bad flight. It's a bad pipe. The reality of it is, don't get emotional about it. I know the first couple of times it's hard to see your money go to zero, or not even zero, but go like to 30% down. You're just like, oh, I can't sell now. You've got to stay the course and not listen to talking heads. You've got to make it about what the numbers tell you. If you're investing, this is so simple, but like the Warren Buffett 101, and this extends to startups and it extends to private assets. If you just pick things that you believe to be good companies, fundamentally strong companies that have a product that people love and that they will need, it's a good investment. I don't care what happens on Monday, April 7th with the stock. It's a good company and it'll be around in 10 years, or it's not. And you're making, then you probably need to hire a money manager.
Yeah. Well, I think the takeaway here, we're going to continue to monitor the online private markets in the coming months. Sometimes there can be a bit of a lag, right, from the public markets. If people see their 401ks and other retirement plans, they might pull back a little bit on investing and other spending in general. But based on last month, we'll see how the trend continues. Right. However, let's jump into the next segment. I think, what you were talking about there, just in terms of investing in sustainable companies, like good companies that have solid businesses. I'm going to pull in our senior investment associate, Leah, to talk about a deal that we've recently been looking at that is raising on WeFunder, and that is Rise Robotics. I will pull up the screen, but Leah, why don't you give us a quick overview of what Rise Robotics is and what they're doing?
So you just said solid business, Brian. I don't know yet about that. It's still way too early to know whether that's solid, but definitely very exciting. So Rise Robotics, let's talk about the problem they're solving first. Most of you probably have heard that word, hydraulics. Some of you know what it is. Some of you have no idea. Hydraulics are basically the strength of machines. I want to say kind of the pushing system that allows for heavy lifting. So if you think about heavy machinery, whatever helps lift heavy weight is hydraulics. And today, hydraulics is just really an old technology that must be improved. There's a lot of reasons about that. First, it's pretty energy inefficient. They waste a lot of energy because they use fluid compression and heat dissipates a lot. There is high maintenance costs. There's a lot of leaks, sometimes contamination. There's an environmental hazard because they use fluid, which causes pollution. They're pretty heavy, bulky. And because of that, because of the high energy intensity, they prevent the electrification of heavy machinery. So that's where Rise Robotics is coming in. They built a new system called Beltronics. And I get the name because it's true, it looks like a belt that is kind of tangling all around. And kind of the idea is that instead of pushing like what hydraulics do, they are pulling like a muscle. And what is very interesting is that they use 90% less energy than traditional hydraulics, making electrification of heavy machinery finally possible. It eliminates the hydraulic fluid, so there's less pollution, less waste, reduces maintenance cost, reduces environmental hazard. What is also very interesting, because you might be thinking, okay, it's going to take a time to replace whatever fleets of heavy machinery that we have. But what's interesting here is that it can be retrofitted into currently existing machinery without major cost or major redesigns. And if you've heard me talking a little bit before, I talk a lot about climate tech, this is what I care about, but I'm also aware that this is not what is going to make the company successful. What is really going to make it successful is, does it make financial sense for its customers? And in this case, yes, it does. So the system of Rise Robotics, the Beltronics, is 2 times faster than hydraulic system, which means that it actually saves time because it's quicker. Companies can operate faster and just make way more money in the same amount of time. So right now, the company is going to try to first launch its product for the lift gates. So you probably have seen lift gates around when you have a delivery of food, beverages in a store. The lift gate kind of pulls these products up and down. Imagine now if you can do it twice faster. It means time saving and so cost saving for delivery companies, for food and beverage companies. And so the company has seen that they can allow Liftgate to do at least one more delivery a day, which is going to be increasing the revenue potential of this Liftgate. And that's where I think the potential really is for Rise Robotics.
Awesome. That's a great overview. I think, coming from a mechanical engineering background, I've definitely had my fair share of interactions with hydraulic systems and the complications and just the mess, but they are super powerful in terms of their lift capabilities, right? So how does the actual investment opportunity break down, Leah, in terms of what's being offered?
Yes, right now we have a pre-money valuation of close to $50 million. If you look at the revenue, you're going to see 4.3 million. So this is not coming from product sale. This is coming from development grant. The company has relationship with different entities, including the DoD that gave it development grants and allowed it to kind of develop its product. So we are on we're on a pretty higher price right now when it comes to the valuation. Now, what is exciting, and I don't think everything's on WeFunders. I can't really tell much about that, but we know from the current CEO that the company has potential pilots that should be starting soon with major corporations and make it kind of an interesting time at which the company can invest. It has a pretty good pipeline of potential pilots, potential customers, and so the future does look good. Now, of course, it's still risky because they're probably have done about 90% of the development of the product. They're waiting for these pilots to be able to finalize the product and really adapt them to what customers need. So we still have risk right here, but I do think that they're at a pretty good position. Now, 50 million is a little bit high. And I think it's up to up to investors to try to think what's the potential of this company. In my mind, I do think that a revolutionary company like that can grow quickly enough, large enough, can probably find different ways to either manufacture itself, which is the plan right now is kind of to co-manufacture with another company, but they could also potentially license their product in the future. I do think that there is a potential for them to grow to $500 million valuation. Obviously, we have no idea what's going to happen, but it's not impossible. So the valuation right here shouldn't be preventing investors from investing, but just kind of making them think, is that company really interesting? And if you go, Brian, on the update section of WeFounder, you are going to see they won the Guinness World Record for the world's strongest robotic arm prototype, which is kind of proving you that there is a potential in this technology. They are actually doing better than competitors. So that's not just about climate. That's not just about cost saving. That's also about having a better product.
That's really impressive. I would have figured there'd be, trade-offs as with everything, obviously, versus hydraulics. And I might have thought originally maybe it doesn't have the same lift capacity, but it sounds like it's higher precision, it's potentially less maintenance, and even the higher lift capacity. Now, Scott, I want to bring you into this conversation. I know, sometimes I look at deals like this and feels a little bit different than other opportunities you might be more thinking about in terms of software SaaS type businesses, right? Something like this, probably very capital intensive. But what are your first impressions in terms of this Rise Robotics opportunity?
Yeah, it reminds me of if modern day manufacturing businesses just started online. You know what I mean? There's a part of me that I would be totally honest, like 2017, that's not true. 2018, 19, 20, 21. I would look at these deals and be like, Jesus Christ, if this is the future of crowdfunding, like we might as well just pack up shop. I now look at this and feel like it's starting to carve its place. Like this is a highly speculative, but highly possible opportunity space. And like, it's thank God it's not SaaS. Like I'm just kind of done on the SaaS. I think it's going to have a hard time in the future. Again, plugging my podcast from a week ago, or whatever, with Newcomer. Like he talks about it. The SaaS model is just very difficult. What I love about deals like this, one is they've got revenue. Two is that year over year revenue is growing quickly. Three is that they are attracting both private equity and venture capital into their deal. And four, and this is the biggest four, if things don't go perfectly right, they still have assets to sell. And I know that does not mean that I will get paid. I'm not expecting that I will get paid as an investor at the end of the rope. But I like businesses that have, the downside is that they cost a lot of money to get started. Like comparative to SaaS, like this costs money to get off the ground. But if you get off the ground, you have an asset. You have more options than a SaaS company, because instead of just using ramp and basically leveraging your revenue, you can actually collateralize your assets. And they have access to different kind of capital opportunities that others don't. And all of that is to lastly say that for this company in particular, Rise Robotics, they are in a space that I believe the next 10 years, there's a lot of interest from venture and other, and I don't even mean just Rise, like just the robotic space in general, being able to use mechanics to supplant and or help empower the human body, I think is going to be a big deal.
Yeah. If you start thinking everything, right, that, even Tesla and some of these other companies that are working on robotics and being able to enable higher precision, like this sounds like it does, sounds like something that will be very important, and the electrification aspect, right, versus something like hydraulics. Now,
Brian, if I could just one real thing, like this, there's another part of this, like we're pointing at this company. This is why we talk about investing in alts and infrastructure and other stuff just a segment before. As these type of companies become commonplace, they open up new opportunities for growth areas where, as an investor, in particular, I'm speaking to the retail investor this isn't their full-time job. It's really hard to pick an individual stock and win. It's much easier to pick a market. So like, as we start to see things like Rise Robotics come into play, it is going to open up entirely new, you talked about it briefly, like private credit, public private credit. Like it's going to open the door to different mechanisms of investing that I think most of us have never had access to. And it's not because of the wealthy elitism. It just like literally wasn't a thing. So I'm really excited about that stuff. And the fact that you can get it on WeFunder as a regular person is awesome.
Yeah. So I just want to point out one other thing that investors, especially users of Kingscrowd, should be aware of. So we do break out the amount they've raised. So if you look at this chart and you say, okay, they've raised $1 million, is that really going to be enough for a company that's perhaps is going to be capital intensive and they have a lot of capital needs as this robotics company? Well, actually, they've raised almost $12 million to date, and that includes a side-by-side Reg D on WeFunder. So this is something that we track. So if you look, when WeFunder lists an amount like this, that's including both the crowdfunding raise as well as off-platform. So Leah, I don't know, do you have details in terms of some of those other investors, angels, VCs? And then I know they also have the additional grants on top of that from, I think, the DoD and those others you mentioned.
Exactly. So as we can see on Kingscrowd page, right now the runway is pretty low. The company has only a couple months left of burn. And that's pretty risky because, as Scott said, we are talking about a capital intensive company. Now, where am I reassured here? I see that the company already raised, I think, about $22 million, some of it from prominent VCs. I don't see any of them dropping a company at the moment where they are actually finalizing the product, where they're actually getting onto pilots and actually, getting so close to getting customers. So even if the runway is low, I think that numbers tell us there's a big chance that, some of these people are going to write them a check, a bridge round, waiting for them to start commercialization. I think that, yes, there's a low runway, but in that case, the financial risk is still pretty low.
Awesome. I think that's one of the super cool things as well. So you can see here, you're getting preferred equity. You're essentially investing alongside some of these much larger, right, VC funds and professionals who probably have done super deep diligence on this deal. So it's not always, but it can be a positive signal, right, to be able to co-invest in some of these larger funding rounds and getting similar, if not exactly same deal terms as those larger investors get.
That's why Kingscrowd is awesome, Brian, for real. Like, this is one of the things that I think stands out that's like really hard to like sell in an ad. And this is not an ad for it, it's just a fact. You can take what Leah just said and deduce that the company is more than likely not down to $287,000 in their entire bank account and they have no hope. Like, you look at the entire profile here, which you wouldn't get if you just looked at their page, and you can start to like tie things together. You can reach out to the founder, you can do all kinds of things and realize that like there's a lot bigger pieces, to the puzzle. And I think Kingscrowd helps round out the picture. I think that's a big part of it.
Awesome. Well, if that's not a strong enough suggestion to anyone out there who isn't already a Kingscrowd user, but most of this data that we just showed you is completely free. So you can head over to kingscrowd.com, create your free account. We also do have a weekly newsletter where we send out a lot of the great ideas like those funding charts, like some of these other insights, as well as these podcasts and other great resources. So make sure you join our newsletter. I think we will wrap things up for there today. So thank you both for joining us, and we'll see everyone back here next week.